Good morning. Good morning. It's Wednesday, November 8th, and we are live here on Clubhouse, YouTube, Facebook, Twitter, LinkedIn. And what we're going to be talking about today is what are the 7 things you must do before getting a mortgage? Oh my goodness. Listen, I had to actually extend it to 8. So if you want to see this, what we're going to be talking about on screen today, you need to go to YouTube so that you can follow along on a separate device. So what I'm going to do is I'm going to go in and get the link from today's show and put it in Clubhouse so we can share it. So we're going to copy it there. And if you want to see what's going on, go ahead and there we go. We're going to paste it in there. And so we could send that out. There we go. And there it is. And let me see here. We are now going to pin my link to the top as well. There we are. ice10k.com. There we are. And we're going to crawl it across the screen here while we are live. Okay, there we go. All right, ladies and gentlemen, thank you for being here this morning. We are getting ready to go talk about the 7 things you must do before getting a mortgage. And if you want to come to the stage, just raise your hand. And if you got any questions about that, please do come to the stage. But I'm going to be putting some things on the screen and you will want to see them. So let me prepare my screens here. All right, there we are. Get this off the screen. There we go. All right. And so let me see here. All right. We had to expand it to 8 things. 8 things. Okay. Here is the first. Let me put that on the screen here for you. We're going to share our screen. All right. There it is. Okay. 8 things we need to do before getting a mortgage. Number 1, be skeptical about all banking products. Be skeptical about all banking products. What do I mean? When the bank is offering you something, when you're trying to get a mortgage or any loan or do any business with a bank, be skeptical about anything they offer you that sounds like it's making money or saving money for you. Okay? Because banks are a business. They are a necessary business, but believe me, they're not your neighborhood friend. They are a bank, they are a business, and you must treat them like they are business. So when they're offering you something, you automatically have to ask, what's in it for you? You automatically have to ask that. So if you want to see what we're putting on the screen, go ahead and go to the link that I put in the chat so that you can see it on YouTube on a secondary device. Pull up a second phone or a laptop or an iPad of some sort. So go ahead so you can see what we're talking about. Number two. Now here, listen, before we move off of number 1, anything that sounds like it's saving you money, you have to be able to ask this question. If I'm saving money, who's losing it? If I'm saving money, who is losing it? You got to ask that question. All right. And if you're really saving, that means somebody else is losing. And if the only answer you can come up with is that the bank would be losing, I guarantee you they're not. I guarantee you they're not losing a dime. So the more it seems like you're making or the more it seems like you're saving, man, you really have to watch out for those, because that's when you really are going to get stuck. Now, am I saying banking is bad? No, I'm just saying that we all should be educated before we go into a bank. All right. So remember, ask that question and that will help you. If I'm saving money, If the bank is offering me something that saves me money, let me ask the question, who's losing, and then dig into it and see what's in it for the bank. All right. And if you can't find the answer, you contact us at ice10k.com and I'll tell you the answer. Whatever they're offering you, you give us a call and we will share that information with you, how the bank is making money on this deal. Okay. So now the second thing you need to know before getting a loan, and this is going to sound crazy, you absolutely have to know how a loan works. Can I get some? I got three people in here. Can I get you guys to come up on stage? You don't have to say anything. Just come on up. Inca, Paula, Maurice, come on up to the stage in Clubhouse here, and that will encourage more people to come in. We have some folks that are here online with us. So say good morning, all you guys that are online. Say good morning, and tell me where you're from. All right, there we go. All right, just raise your hand in Clubhouse. All right, so listen, the next thing, learn how a mortgage works. Now, this is going to get probably a little complicated because we have to actually do some calculus. Now, I'm going to break this calculus down so that even I can understand it because I am not a math person. All right. Good morning, Inca. Listen, when it comes to mortgages, when it comes to how all of this works, we have to be careful. Let me pull up another screen here on top of this one. Okay, Eric Toombs is here this morning. Good morning, Eric. All right, so we're going to pull up a new window. All right, and then let's see. I'm pulling up something here. Our amortization formula. Okay. I'm putting that on the screen right now. Here's an amortization formula. Okay. Now, the amortization formula, all right, is designed going to do one thing. It is to distract us from what's really going on. You think it's about interest rates. You think it's about how much interest they're charging us. But the amortization formula, which gives you a payment you can afford for 30 years on a mortgage, it's really about the principal payment on each loan. This thing here calculates how much money goes to principal on each loan. And when you find out how much money goes to principal, that's called the rate of change. That's called the rate of change. So when we're talking about the rate of change, let me tell you, the slower the rate of change, the more times you have to pay, the more expensive your loan gets. All right. So it's not about the interest so much, but the rate of change, because that means how many payments you're going to make. Let me show you what I mean here. I'm going to bring up an amortization schedule. We're just going to do a $200,000 mortgage. Okay. At, I get the wrong number here. $200,000. If you want to see this, go to YouTube. 200,000 at 6%. And we're going to study the rate of change on this. Oh, I want 6%. It's actually 8% now. Mortgages are 8% now. Okay. So let's take a look at this. When you make this very first payment of on your $200,000 mortgage at 8%, $1,333.33 goes to interest. How much goes to principal? $134.20. That, my friends, is called the rate of change, because now I used to owe $200,000 on my mortgage, and now it's changed by $134.20. That's how much went to pay down my mortgage, $134.20. See, the idea is to add up all of these principal payments till I get to $200,000. add up all the principal payments until I get to $200,000 and then I'm done. But if the rate of change is, oh, this month, $134.20 out of my money goes to principal. Next month, $135.09. Next month after that, $135.99. It's only changing by about 90 cents. My amount of money that's going to principal each month is changing by about 90 cents in the beginning, plus the amount of money that's actually paying down the principal starts out at $134.20. What happens? My entire payment is $1,467.53. This is why we need to understand how a loan works. You won't get that education anywhere else. You won't get it from your banker. You won't get it from your real estate agent. You won't get it from a loan officer. You will not get this information from Dave Ramsey. You won't get it from Susie Orman. You won't get this information from your business classes. You won't get it from your CPA. You're only going to get it here. You're getting it here for free. How a mortgage actually works. And if you want to see this, if you're new to the room, go to YouTube so you can see what I'm talking about. Now, here's the rate of change, $134.20, which means I still owe $199,865.80. If I owe that much, then I have to make another payment, don't I? And when I make that other payment, only $135.09 goes to principal. The rest of the money is attributed to interest. So what interest is, it subtracts money out of your payment and makes the rate of change slower. You see, you want to pay down this loan, but the way that it has been designed is that so little money actually goes to pay down the loan. What happens to the rest of the money that you paid? It's subtracted out of the payment and it doesn't count for you. Who does it count for? It counts for the bank. It counts for the bank. So at the end of 1 year, because of the rate of change, $134.20, and it starts there and it ends the year with $144.37. When you add all the principal payments up for a year, it only comes to $1,670.74. What happened to the rest of that money out of 12 payments? A total of $15,939.62. That slowed down the rate of change. The amount of interest and the amount of principal payment slowed down the rate of change. So at the end of, you started out with $200,000 owing. At the end of 12 months, you still owe $198,329.26. We don't know how the rate of change actually works. What you need to do, ladies and gentlemen, is figure out how we can speed up the rate of change. This is the most dangerous distraction, is to look at how much money is going to your mortgage and then assume more money is going to principal than you thought. You're actually paying the loan down so slowly. When you understand what's happening, you have to make 360 monthly payments. Let me put that back up on the screen. 360 monthly payments. There it is. 360 monthly payments so that enough principal is credited to your loan so it can look like it's being paid off. Okay? Listen, I'm scrolling through this thing. 180 payments. Look, is 20 years. Okay? 180 payments, 20 years. Look, only $440.84 at that point is still going to principal, and still over $1,000 is going to interest each month. We keep scrolling down. Okay. I'm sorry. 180 was 15 years. Did I say 20? It's 15 years. 240 payments is 20 years. Okay, $656.78. Now the rate of change starts to pick up. The rate of change starts to pick up after about 20 years. And you go from 656, the next year, 711. The next year after that, $770 goes to principal, then 834. You see, it starts to really pick up after about 20 years until you have $1,000 going to principal and $400 going to interest until you're finally done. The rate of change is what we need to pay attention to. Okay. Now that you know about how dangerous a loan is if you don't understand it. Now, I like these loans because not only do I understand the rate of change, I understand how to increase the rate of change so you can pay fewer payments. When you pay fewer payments, then you pay less interest. More of your money goes to where you want it to go. You want it to go to pay down the loan. All right. So let's see what our next note says. Okay. So don't get distracted. Don't get distracted by interest rates, by paying down, buying down points. Don't get distracted by all of that. Because what's really happening is you need to take a look at that principal payment, okay? Because we're going to learn a little bit about that principal payment, because when you control the principal payment, you actually control the loan. It looks like they're controlling the loan with that small principal payment, but in actuality, you can control this loan. All right, so learn how to control a mortgage to help you. Control the principal payment and you control the loan. And the interest payments you skip don't matter. Now, once you understand at these higher interest rates, that so little money goes to principal, but now you can control the principal payment. So let's say we're looking at payment number one. Number one, you control, listen, understand this, controlling the interest payment, the principal payment, controlling the loan. So if at these higher interest rates, if you can afford the payment on your mortgage, don't let the higher interest rates scare you. Now, for some, the higher interest rates just kind of take you out of the game. I get that. But if you can well afford your mortgage at the higher interest rates, let me show you how you can make that work for you. All right. Start inviting some more people in. Share this online, and this whole video, you want to share with your realtor. You want to share this video with your mortgage lender. You want to share this video with the people at church. You want to share this video all over the place, because right now there are people that are struggling and thinking about how they can get into that house with these 8% interest rates, and they're scared of the interest rate, but they don't understand what the interest rate can actually do for them. Okay. There are people out there that are getting ready to refinance, but because of the higher interest rates, they don't know how to manipulate the interest rates so that they can win. By understanding how a loan actually works, ladies and gentlemen, you can make higher interest rates work for you when you understand this point right here. Control the principal payment and you control the loan. Let me show you. If I make this first payment on the loan, $134.20 goes to principal. So I pay down my $200,000 where I owe $199,865.80. That's what I have left to pay. Okay. So the bank uses this number to create my next principal payment, which is a very slow rate of change. My next principal payment goes to $135.09. That's what this formula does. It creates a very small rate of change. And so now I can, I have to pay most of my money that I give them the next month that goes to interest, and a very small amount goes to principal. Now, let's say I make my first payment in January. and my principal payment for February is $135.09. Now that's a very slow rate of change if I wait till next month. But what if I pay that in this month? What if I pay it in this month? Oh my goodness. I need to show you this. Okay, can you guys hear me? Hmm. All right. I want to make sure you guys can hear me. So somebody put something in the chat if you can hear me online. If you can hear me on, all right. Hopefully you guys can hear me now. I don't know what happened, but maybe you can hear me. Okay. Listen. Okay, so here's where we are. Here's where we are. Understanding the interest cost is so very important in this whole business of understanding how much you're truly paying for the house. Now, if you don't want to pay $528,310.80 for your $200,000 house, then learn how to pay less. Learn how to pay less. All right. I'm still looking for a comment online. If you're listening to me on YouTube, on Facebook, Twitter, or LinkedIn, put a comment in the chat so I know you can hear me. Can you hear me? Put a yes or a no. Oh, well, if you can hear me, put a yes. All right. Man, maybe they're not hearing me. I don't know what to do. I think I've got everything on. I'm not muted. And I'm not muted here. I'm not muted there. I got all my sound up. Let's see here. Okay. Well, I think you guys can. Oh, okay. Christina says she can hear me. Thank you, Christina. Appreciate it. All right. All right. So here's what we need to know now. All right. When you're understanding how much you're totally paying for I need everybody to pull out their mortgage papers. I need everyone with a mortgage to pull out your mortgage papers. If you're about to get a mortgage, I need you to pay attention to how much interest the bank wants to charge you for that loan and then add it to how much you're borrowing. All right. That is the true cost of your house. That is the true cost, and you don't want to pay that. So learn how not to pay it. All right. So that is we went over 1, 2, 3, 4. Learn the true cost of your loan over time and learn how to work to reduce the cost. Understand cumulative interest and cumulative principal. What do I mean by that? Cumulative interest and cumulative principal. Now, you can do this for yourself. What I've got here is brettwhistle.net. I'm going to copy the link to this amortization schedule that I'm using as a teaching tool so you can have it. And you need to play around with it. All right. So I'm sending that to my folks here in Clubhouse. I'm putting it online for my folks here. There we go. There we are. All right. So that everybody online can see it too. All right. So I need you all to play around with this thing and focus on. Now we're focused on cumulative interest and cumulative principal. Now, why do I think that's important? If you run your mortgage through this amortization calculator, you're going to get 2 columns you will not get in your own amortization schedule you receive from the bank. You're going to get 2 columns you don't get from the bank. You're going to get cumulative principal and cumulative interest. So every month, this thing will add up how much principal has been paid to your paid down on your loan and how much interest you have been charged to do it. So in month 1, $134.20 principal, $13.33 interest. Well, second month, now we have a total of $269 going to principal, and in the second month, $2,665.77. 9 months in, $1,240.48 has gone to principal, where $11,967.29 has gone to interest just in 9 months. In 12 months, look at this, 1670 and 15,939.62. In 5 years, you're in this loan 5 years. This is why it's important to understand cumulative principal and cumulative interest. How much of your money is going where you don't want it to go? All right. So at the end of 60 months, $9,860.35 goes to principal, where $78,191.45 of your hard-earned money did not pay down your mortgage, but went to an investor. $78,000. Folks, do you know that's a lot of money? That's a lot of money. If we go down, let's see. Most people refinance at the end of about 7 years and start the clock all over again because they're not looking at total interest cost, cumulative principal and cumulative interest. They're not looking at it. And when you look at it, you will make different decisions about your money. In the 7th year, when most people refinance between 5 and 7 years, only $15,045 is paid down this loan. But look at this, $108,000. $108,000. $123,000 has been paid out. 123 grand has been paid out to your mortgage company or to your bank. And out of 123,000, only 15,000 of that money helped you. This is why it's important for you to understand cumulative interest and cumulative principal before getting a mortgage. I hope this is helpful. Ladies and gentlemen, let's see what is our next move here. All right, let me bring this back. All right, so we have learn to control and control. All right, learn about cumulative interest and cumulative principal. All right, and now we're going to learn the power of prepayment. You see, P.I.L.L method stands for prepayment of principal, isolating the principal amount, leverage, and liquidity. And you need to understand the power of prepayment. What happens when you prepay? What happens when you choose to give the bank money before they are expecting it? Okay? And what they cannot do to you because of it. So when you understand prepayment of principal, let's go back to the screen here. Prepayment of principal. Anytime I prepay principal, that means that's interest I don't have to pay. And it doesn't take a lot. All right. Let me show you something here that I'm going to put a calculator on the screen. All right. And I'm going to show you how powerful it is. We're going to put $1,332.44 in interest. That's from line 2 on our amortization schedule. All right. If I prepay the $135.09, if I pay that early, I don't have to pay the banks $1,332.44. But what if I don't have $135? What if I don't have $135? Let me get my calculator out here. All right. Got my calculator out here. So I'm putting $135 in 0.09. All right. Let's say I have half that money. I don't have $135, but I have half. So I'm going to divide that by 2. That means I have $67.55. $67.55. So if I only prepay half the money, guess what? I save half the interest. So I'm going to divide that interest by 2. Look at this. If I prepay $67, that saves me $666.22 in interest I never have to pay. Let's understand prepayment from this point of view. I don't have $67. I got half of that. So we're going to divide that by 2. I got $33.77. If I prepay that, I will save half the 666. So we're going to divide this by 2. Let me ask you, ladies and gentlemen, if all I have is $33.77 and I can put that on my mortgage, is it worth it to save $333 in interest I never have to pay? You tell me. You tell me if it's worth it. Okay? Christina Daniel says, it's never too late. It's never too late to start this. Okay. What if you're already, is it ever too late to start this? What if you're already 15 to 8 years in on your mortgage? Are there benefits just the same? The benefits aren't the same, Christina. The benefits are not the same. Because the higher interest costs are at the beginning of the loan. Now, no matter where they are, this is why we ask each client to do what's called a savings and earnings report. No matter where you are in your mortgage, you can send us your financial data. We will calculate how much interest you have left to pay. All right. And then let's see if we can save you 50 to 75% of the interest you have left to pay. Now, you may have significant amount of interest left. Okay, so let's go down 15 years. That would be 180 payments, Christina. I'm going to put this on the screen. Okay, we're going to go down on this $200,000 mortgage at 8%. We're scrolling down to payment number 180. Let's say the folks got to me here. All right, so 180. That means they've already paid $217,000 in interest, $217,718 in interest. Now, how much interest were they supposed to pay for the entire loan? All right. So if we go back up to the top here, we see that they were supposed to pay $328,000 in interest, $328,000 in interest. So let's put that in our calculator. Okay. So we pull up our calculator and we're going to put $310 in our calculator. Oh, let's not forget the 80 cents. Let's put it all in. Okay. All right. And then we've already paid. Okay. How much have we already paid? We're going to go down to payment 180. That's 15 years in. All right. All right. We've already paid $217,718. So we're going to subtract $217,718.20 equals, they still have $110,000 left to pay, Christina. $110,000 they have left to pay. If they work with us, what if I could get them out of debt and they only have to pay what, 20, 25,000? So would it still be worth it to them? If they still owe 110,000 and I can with us subtract 25,000, they end up paying 25,000 instead. I still save them $85,592.60. Is that still pretty good? So it's not going to be the same amount, but it still will be significant. That's why everybody does a savings and earnings report to see if it's going to make sense for them. I've actually had people call me up who had 5 years left, or 6 years, or 7 years left. And I literally had to tell them, are you getting another mortgage? Are you in your forever home? Are you in your forever home? And they said, no. I said, well, if you're thinking about trying to save money on this home, most of the interest has already been paid. But if you're going to get into another home, we could start on this one Okay. We can start on this one, and then we can transfer over to the next one. Okay. But if you're already in your forever home, then I can give you some advice on how to save some additional interest. Now, here's the other thing you need to think about. When this is why you need to understand cumulative principal and cumulative interest. Okay. Hold on for just a second. Somebody wants to bring me something. I gotta send them a message. There we go. All right. Um, so if we understand this, I need you to look at what happens when we get deeper into the amortization schedule, Christina. Okay. If we get deeper into the amortization schedule, I need you to see there's a certain point at which, do you see here where if we wanted to save $312 in interest, we would have to prepay $1,155.33. When the deeper we get into the loan, the more we have to pay to save less. So there comes a point when it doesn't make sense to prepay the loan anymore. You could put that money, the money that you could prepay on the loan, you could put elsewhere in a investment and make more money with that money than you could save in interest. Does that make sense, everybody? There's a certain point at which you don't want to prepay anymore because it takes a whole lot of money just to save a little bit of interest. And the deeper you go, it gets worse. Okay. So here, if I prepay $1,355.07, it only saves me $112 in interest. So be careful. This is why if you have a calculator, you can play around with this thing. It is important to understand cumulative principal and cumulative interest so you can do the math easy so that you can see for yourself. Um, what else can we learn here? Okay, what else can we learn? If anybody has any questions, go ahead and put it in the chat or come to the stage. Okay, if you're in Clubhouse, come to the stage. All right, so here's what we're going to do. What we are doing here is we're going to go to our next point. Okay. Okay, so we're going to focus right now. We're going to focus on prepayment. All right, and how prepayment saves us more money. I just showed you that a little bit of interest, a little bit of principal can save a ton of interest. Okay, but what if we have a little bit more? What if we have a little bit more? Okay, let's see here. Let's take a look at, let's go back to bringing that's it. Okay. What if we have just a little bit more? All right. So if you have, let's just say, can I give you an example of what I'm talking about? Right now, somebody that's looking at this may have like $5,000 that they owe on a credit card. $5,000 that they owe on a credit card. And they're thinking about how to pay that off because the interest cost is so high. Okay. They're thinking about the interest rate is high on the credit card. They want to take that $5,000 and pay it off. And they have the $5,000. Okay. Let's just say the interest rate is what? 20% on $5,000. And they're looking at, I've got an 8% mortgage. I got this $5,000 on this credit card. Let me show you why you want to understand how a loan actually works so you don't make big mistakes. Okay. So I'm going to bring up another amortization schedule. We're going to put in $5,000. Okay. $5,000 at 20%. All right. And now if you're using the Brett Whistle, then remember that when you're putting in, you're trying to figure credit card interest, Make your regular payments 240 because all credit cards are amortized over 240 months. So now we're going to take a look at that. Okay, delete that. And now, how much interest does the bank want me to pay right now? Look at this first interest payment, $83.33. $83.33. So if I take that $5,000 out of my bank and pay off the credit card, that makes it impossible for the credit card company to charge me $83.33. But if I take that $5,000 and put it on this mortgage, it knocks off 34 payments. 34 payments I never have to make and saves me $44,000 in interest. 44 grand in interest I don't have to pay. Do you see why now we need to understand how these loans work? Do you see why now it benefits the bank that we don't know how these loans work because we're putting our money in the wrong place trying to do the right thing? Does that make sense to anybody here? The links don't work in the chat for me. Okay. Okay. I'm sorry. So if you want to go to YouTube, so go to YouTube, Joe, go to YouTube on another device and search for P.I.L.L method in YouTube and you'll see our live. Okay. Now, I'm not saying don't pay off the credit card. I'm just saying don't get so locked in to that 20% interest rate and not focus on interest cost because that is the bank fooling us again. You see? But if I look at the interest cost on this thing, $44,000, I could save in interest by putting that money on the mortgage and knock off 34 payments. Come on. Who's teaching this? Why are we taught to hate credit card interest so much that we will ignore interest on the mortgage and pay this kind of money to the bank? I don't get it. Why hasn't Dave Ramsey pointed this out? Why hasn't Susie Orman pointed this out? How about any other financial gurus that you can think of? Why aren't they pointing this out to the masses? Could it be because they don't know any more about how a loan works than we do? Could it be that they don't know either? So, Christina comes on Clubhouse with us today. Hi, Christina. How are you doing? So I don't know if she's on her way to work. she might be at work already. I don't know. Hey, Christina.
Hey, good morning.
Are you on your way to work?
I'm already at work. I am already here because I can't figure out what time you guys start now. I'm like, I thought I was gonna catch it later, but I don't think I catch it later. I think I catch it in the middle.
Oh, okay. Well, when you because we start at 7 a.m. Eastern. I'm sorry,
so
7 a.m. Central. 7 a.m. Central.
Oh.
7 a.m. Central.
So
Okay.
that should be 6 a.m. for me, I think.
So are you because you guys don't do daylight savings time. Okay. Nope. What time is it there now?
It is just about to be 7.
Yeah, it's 8 o'clock here. So it's only an hour difference.
Okay.
Okay. So so we come on at 6 a.m. your time. All right. So anybody else want to come to the stage? Come on up. Just raise your hand. Come on up. Christine, did you have a question or comment?
I didn't. I just was switching from Facebook to join on Clubhouse. So
Okay.
Listen.
All right. Sounds good. Sounds good. All right. Well, thank you for being here. All right. Listen, can I get, okay. I got TC wants to come up. Come on up, TC. Anybody else raise their hand? Come on up. TC, how are you doing this morning?
I'm doing well, sir.
Do
How are
you?
you?
I'm doing
And
well.
how's the room? Good, good, good.
All right, man. We're going over 8 things people need to know to before they get a mortgage. So we're just going over some of those things now. You want to catch this from the beginning, but right now, we are just going over the importance of prepayment and understanding the difference between interest rate and interest cost. All right. So now we're looking at the value of prepayment, knowing that I could prepay my credit card. All right, and save $80 in interest. I can even if it's at 20%, but I can pay off I can pay $5,000 off on this mortgage and save $44,000 in interest. That is what we need to understand what prepayment is all about and how it can benefit us. Is there anybody else that wants to come to the stage? Okay. So now if you came late, make sure you catch the replay on YouTube. Go to look up P.I.L.L method, P-I-L-L method on YouTube, and you want to see this from the beginning. All right, because we've already gone over. All right, we've already gone over 1, 2, 3, 4, and 5. We've already gone over 5 of the things that you need to know before getting a mortgage. Now we're looking at isolating the principal amounts. That's the I in P.I.L.L method. Isolating the principal amounts, meaning how much should I pay and when should I pay it? And which loan should I attack? So I'm going to isolate out of my budget. How much of my budget can I use to to prepay my debt so I can save a ton of interest without paying too much? Isolating the principal amount. How much should I pay? Okay. And I'm telling you right now, it takes a lot of math to figure that out. Okay. We have an opportunity cost calculator that does all of that. Okay. So let me give you an example of why it is important to save money this way. By isolating the principal amount, it can be figured out how much interest you're saving per dollar. Every dollar you put on your loan, you can save more or less interest. Did you know that? You can save a lot of interest or you can save a little bit of interest with every dollar. So let me give you just a quick example of why you don't want to pay too much at the wrong time and violate the law of diminishing returns. So you want to isolate the principal amounts. You want to know exactly to the penny how much you are going to pay. All right. So let me bring my amortizations calculator back up, and I'm going to show you the difference between line 12 and line 24 here. Okay. Now, if you were here earlier, you learned that if we prepay this $1,670.74 on this mortgage, we knock off 12 payments we never have to make, and we save over $15,000 in interest we don't have to pay. Okay. Which is pretty good. But look at line 24. What if you had plenty of money in the bank and you could choose between prepaying line 12 or prepaying line 24, $3,340, and save $31,000 in interest? You would be tempted to do that. You'd be tempted to do the $3,400 and knock off 2 years all at one time and save 31,000. But if we do the math, because see, it's important to save the most per dollar. So if I put my $15,000 that I'm saving, 15,939.62. All right, and I divide it by my 1670.74. That's how much I paid. 1670.7. Oops, delete. 0.74. That's That's $9.53. I got to round that up. $9.54 per dollar. $9.54 per dollar. Don't you think that's important to know? That once you understand how a loan works, that even an extra dollar placed on your loan could save you $9.54 in interest. You don't have to pay the bank. Has anybody ever broken it down like that to you before? In simple language so that we can all understand it. So if I can save $9.54, now it says 9.538. And because we have this 8 here, we round up the 3 to a 4 to $9.54. That's what your bank does. Okay. So let's take a look at line 24. We're going to write down our $9.54. That's how much we save per dollar at this juncture. But what if we had the money to do this one, line 24? So we're going to put in our 31,740 and 58 cents. And we're going to divide it by $3,480.14. Divided by $3,480.14. Now, most people would think they're better off by paying more or paying the most they possibly can. All right, let me show you something here. Equals $9.12. Before, we're saving $9.54 per dollar. Now we're saving $9.12 per dollar. And the more we put on, the less we're saving per dollar. Now, why is that important? Because you want to find out what the critical point is in putting money towards your debt. What is the right amount at the right time so that I can save the most with the least? We're talking about critical point analysis. Critical point analysis will help us to find out when does more become too much? When does that one penny break the camel's back? When does that next cent mean that I'm going to save less interest per dollar? Well, we got a calculator that does all that. And here's why you need to know. Because if you can't save the maximum amount of interest with the least amount of money, that means you could be putting money elsewhere to make more money. Let me give you an example. I have a guy here in Huntsville, and he's making more money now than he was when he started our program. When he put in the extra income that he's making, he can now pay off the $260,000 that he owes on his house now in just 3.5 years. 3.5 years. And he's excited about that. And I told him, well, what does the program say? How much does the program say? How much interest do you have left to pay? Because the program will tell you that. It says, I only have $16,000 worth of interest left to pay. He was surprised to hear me say, you're paying the house off too fast and you're not paying enough interest. He says, what do you mean? Let me show you what I mean. Let's tell the program, okay? Let's have the program recalculate. Just tell the program you're making $2,000 a month less because he's putting all of his income in, okay? Because he's making a lot more now. Let's tell the program you're making $2,000 a month less. And when the program did the recalculation, he's now going to be out of debt in 6.5 years, not 3.5. He's now going to pay $20,000 in interest, not $16,000 in interest. He says, well, Don, how's that better? It's taking me longer and I'm paying more interest. How is that better? I said, well, it sounds like you want to be out of debt in 3.5 years, like you were doing before. He says, well, yeah, I want to do that. I said, well, why do you want to do that? He says, I want to build another house. And I want this one paid for. Okay. So let me tell you what we did next. I showed him by asking him questions. I showed him something by asking him questions. What would you have to do to get out of debt in 3.5 years? He said, I had to put that $2,000 a month back in for the next 3.5 years. He says, yes, I would have to do that. And he was right. It would work out just fine for him. But that's $2,000 a month for 3.5 years. That's 36 months for 3 years, another half a year. Okay. That is another 6 months. That's 42 months. 42 months times $2,000 a month. That's $84,000 he's putting into debt reduction to take his interest that he will pay from 20,000 down to 16,000. So 84 grand paid towards the mortgage is only going to save him an additional $4,000. Do you think he wanted to spend his money like that? Yes or no? Put it in the chat. Okay. He said, no, I don't want to do that. I said, what you need to do is go ahead and build your house now. He says, well, I don't have the down payment. I said, yes, you do. Go ahead, because you got so much equity in your house now. Go get a HELOC on this house now, a home equity line of credit. He takes the cash from the home equity line of credit, makes a down payment on his new $700,000 home. Okay. On his $700,000 home, makes his down payment on that. Okay. And by the time the home was finished, because there were delays because they couldn't get materials in, there were material delays. And with all the delays, with all the frustration he went through to build that house, it's now done. But by the time it was done, the house next door sold for $900,000. $200,000 extra in equity. Okay. And what about his other house? Well, he didn't pay it off. He put a renter in it. Yeah. So I'm going to put a renter over here. And I think he was doing some short-term rental, so he's making even more money. But because of that, he's now going to be able to pay off both houses in about 10 years. How about that? Do you see why it is important for us to understand how these loans work from the beginning? Now, we already went over prepayment of principal, isolating principal amount, and we just went over a little bit of leverage. Okay. I did that prematurely, but the leverage has to do with finding the smallest amount of money that's going to give you the greatest return. Find the smallest amount of money you can put towards your loan that's going to give you the greatest return per dollar. That's what leveraging is all about. I need to put what is the least amount of effort I can put into something that's going to give me the greatest benefit. We look for deals all the time. I just went to the store yesterday. Okay. And here at Publix, they have 2 for $1. So when I go, I look at what's going to be 2 for $1. I look at all the stuff that I use. Okay. And I go and I get it half off. I get twice as much for my dollar because it's 2 for $1. If you go to Kroger's, you might, they might have a product there that you like that you can get 10 for 10. So here's what I'm saying, ladies and gentlemen. We always look to see how we can save money. Some of us even use Gas Buddy to figure out, where am I going to buy my gas? There's an app called Gas Buddy. Where am I going to find my gas today? Where's it going to be the cheapest? Here's my list of favorite gas stations that I like that are close to my house. Which one am I going to go to get my gas today? I use Gas Buddy for that. So folks, why aren't we using some type of technology to figure out what is the least amount of money I can pay right now to save the maximum amount of interest? And I can take the rest of my money that I was thinking about putting on the loan and putting it into an investment that's going to make me money. Whoo! I'm making money with my money, and I'm saving money with my money. Okay. I'm doing all of that. Miss Sharon, how are you doing this morning?
Fantabulous.
Did you have a question or a comment? You just covered to the stage.
Yes, I have a question. I have a young man, and like I said, I send everybody. I recommend the P.I.L.L method to everyone, everyone. But I have a young man that inquired my services on yesterday, and um, he was, and believe it or not, I came in on the end part, but that's what I was telling him. He's like, okay, he's not a first time home buyer, but this is the home that he wants to buy to live in. And he's FHA approved. And he was asking, and because he had like people around him that was giving him knowledge about things. And he was asking, what for an investment property, can I take some of um, my loan and buy an investment property, or do I have to pay everything down, at the house on the house that I would be living in? And I said, that's a good question. I said, so which would you rather do? First of all, would you rather get your investment property, or would you want your home? He said, I want my home. He said, but I'm looking at a duplex. And I said, that's kind of, out of my knowledge of things. I said, but what I'll do is go to Mr. Dunn, the P.I.L.L method man, and I would ask him that very question. And so that's bringing me to the stage to ask, can he do that? And
Can
if so,
he?
how?
Okay, I'm not quite understanding the question. Break it down for me. What does he want to do exactly? He wants to live in a house, okay, and he wants to use his FHA loan to buy a duplex.
Yes.
He can do that.
Yes.
Yeah. Hmm. But he definitely has to live in it. Sharon, I can't hear you.
So he cannot do both, or is that
He
what you're saying?
well he
He can buy.
right.
He, okay. It's no way he can split or get some. I don't know. He was
Are,
kind of. That's what he was
you
kind of.
are you saying he wants to buy a duplex and another house?
Absolutely.
Not with FHA money. Okay. Now he wants to get a duplex and live in one side. He can do that. Are you hearing me, Ms. Sharon? Does that make sense?
Yes, that's what I told him. I said that would be your investment property,
Mm-hmm.
and because you will be living in one side, and the person next door to you, um, because the duplex that he was looking at,
Mm-hmm.
and he sent me the address to it, and it's in when I say upcoming, where the right now is like 300,000 or whatever else, but is out in the suburb area, and it's gonna. I'm looking at numbers that are around there, and they are thriving like at 600,000. So I told him, I said that would be a wise investment, um, because you can just add to upgrade some things in that duplex and be right there when the spread happens, because it's near college, and they're looking at, that's what the average mortgage is around in at 600,000, and he's getting it for will be getting it for like 150,000.
Well, here's the thing. If he can get now, he can get his FHA loan, okay, for his house. Okay. And I like that because he can put down 3.5% as opposed to 10. Okay. So he's putting his down payment on there. So does he have additional monies that he can put a down payment on his duplex once he gets his house? That would be the next question I would want to ask.
Yes, he has 10,000 for like first time
Okay. Now,
home
no,
buyer. And
this is not first time home buyer stuff. I'm talking about investment property now. He's got his house, okay? And now he wants to get an investment property. You following me?
Yes.
Okay, now he wants to get an investment property. So he gets his investment property. He can get what's called a DSCR loan, debt service coverage ratio loan. Okay, it takes less paperwork, and he would have to have about 20% down on the house that he wants. That he can get another loan, and because this is how a DSCR loan works, if the rents cover the payment, that's all that these lenders are looking at. That's what these lenders want. Can the income from the building pay for the building? And does he have 20% down? If he can do that, now he can get his FHA loan, move into his house, and then get a DSCR loan and get his investment property if he has the down payment. What do you think, Ms. Sharon?
That's absolutely right. And his 401k, I think he said he has about 140 saved up in it.
Okay. Well,
Thousand.
if he wants to
So
get into some investment property and you're using that 401k money, you better find somebody that you can work with that has that's skilled in investment property, because you don't want to lose any of your retirement money trying to invest for the first time. Spend the money, get the help you need to do it right. Okay? So you don't lose all of your money doing it wrong. Spend some of your money to do it right, so you don't spend all of your money doing it wrong. Okay? That would be my advice to him.
thank you.
You're so welcome, Sharon. Thank you for coming to the stage. Okay? So folks, this is where we are. We have gone over, I think we've gone over 7 of the 8 things you need to know. To let me pull up my thing here. So we're at learn isolation of principal amounts. We did that. Learn leverage. Okay. And critical point analysis. Critical point analysis. So very important. Okay. Who's going to do the math? Our program actually does the math. Now let's learn about liquidity. That's the last L in P.I.L.L method. This is the final thing you need to understand. Understand all of your money. You know, like Ms. Sharon was talking about, this young man says, I've got this money. All right. And what can I do with it? Now, he's got money in his 401k, in his savings, in his 401k. Now, here's what I'm going to ask. I've got money in a 401k. Okay. I've got $100,000 in a 401k. I have $100,000 in my bank. I've got $100,000. Okay. I've got $100,000 in credit cards or business credit, and I have $100,000 in a line of credit. Okay. I named off several different things that have $100,000 in it. Can I spend? Does $100,000 over here spend like $100,000 over here? If I take that $100,000 out of my 401k, can I spend it? If I take that $100,000 out of my bank account, can I spend it? If I take that $100,000 off my line of credit, can I spend it? They all spend the same, but they don't all cost the same. They all spend the same, but they don't all cost the same. So here's what he wants to do. Now, if in his 401k, he's probably averaging right now between 3 and 5% if it's actually making money on his 401k. If he can get into real estate, he could potentially make between 15 and 20% on his money. Okay? So, if he would work with an experienced investor, would it make sense to take out some money out of the 401k that's only making 3 to 5% and leverage that and buy some real estate over here where he can make 15 to 20%? Do you see what I'm saying here? Some people are looking at their, I'm sorry, go ahead, Ms. Sharon.
I was just saying absolutely, and he was telling me about that's what he had in mind to do because he's a master barber,
Mm-hmm.
so he has his license, and he also drives you know drives trucks and
Mm-hmm.
does that. And he said like, that's what his question was to me. Like, my money is just sitting there. I have a nephew that said the same thing to me that said, Auntie, I need to know what to do with my money. It's just sitting there. I need to. And I was like, the first thing came out of my mouth, you need to invest it. I mean, if you want another home, because he has the one of the family homes, and he was just saying to me that he want to buy his own home because like the family feel he feel like, okay, when the family want to come by and they want to pop up or whatever just to reminisce about things or whatever, he's like their intrusion on his privacy because he's staying in the family house. But the thing of it is, um young man is very successful, and again, I got so many people that are coming to me now. It's like I'm the connector. But I was just, and my first thing is like, listen, learn all that you need to know about purchasing a home at this time and this because a lot of people are like, okay, they're tightening in their wallets. They're like, I shouldn't buy. I'm waiting for the interest rate to go down. I'm waiting. I'm waiting. I'm waiting. I said, you know what? That you need to take action, but you need to know, you need to be knowledgeable of the action that you're taking.
Right.
I don't want to just send you out there, to I what I do is I help find what you can afford. I don't want you to come to me saying that this is your income, and you're looking over and beyond, and you're hoping that all the dots will just fall in alignment. No, let's get the alignment now, realistically, because like home ownership have always been like a dream of a lot of people, but it can be a more reality. You got tiny houses, you got all kinds of options out here outside of the just a brick and mortar uh built from the ground. You got several options if you're just by yourself, single by yourself, and you just want to start a house to get into, or but my suggestion has always been like, if you get a home, just don't stop there. Get you an investment property
Mm-hmm.
to fall back on, to have that, definitely,
Okay.
and it could be right in the neighborhood in which. And you can get a management company, or you can move in it yourself. It's just different things that you can take
Yes.
in purchasing now. So
Okay.
but it shouldn't be shut down. You shouldn't keep your mind like closed minded to it. It's just like there are doors around. Like he never thought of it, that he would meet someone like myself that was encouraging him. Like, yes, get that investment property. You see that,
Okay.
and you know that
Th-
economy on that side of town is
Thank you,
is
Miss
up
Sharon.
and thriving.
We're running out of time.
Okay, invest in it. Okay, okay,
Thank you.
that part. Okay.
All right, folks. Listen, we are getting towards the end of our show here. All right, Ms. Sharon, thank you so much for bringing that question to us because we'd love to have questions. So I need to go over the 8 things again. All right. So number 1, be skeptical about all bank products. If they're telling you they can save you money, you need to look at it all kinds of different ways. Give us a call. We'll tell you where they're making money. Learn how to a mortgage works. Okay. You want to understand the rate of change. This is a most dangerous distraction. All right. Understand how a mortgage actually works and how they make their money. Okay. Learn to control. The next one is learn to control. Learn to control a mortgage to help you control the principal payment, and you control the loan. And interest payments you skip don't matter. All right. Watch the video again. Send this video out to other people. The next one is learn the true cost of your loan. How much is it going to cost? The money you borrowed plus the interest. Okay. We call that interest consumption. How much interest are you consuming each month? All right. And you want to be careful because the average family consumes 35 to 39% of their take home pay just in interest alone. Learn how to control interest consumption. All right. The next thing is learn the power of prepayment. Focus on interest cost, not interest rate. Focus on interest cost, not interest rate. The next thing we learned is learn isolating the principal amounts. Exactly how much should I pay and when? All right. And which loan should I attack? Learn leverage and critical point analysis. What is that point at which more is going to be too much? And then take what's left and I can invest that money. Okay. And then liquidity. all of my funds are valuable. I want to be able to figure out, here is the P.I.L.L method opportunity cost calculator, which of my funds is going to be the best to use here. Do you know how many people I know that have several $1,000s in the bank? I mean, just in a bank account. I met people with between $10,000 and $100,000 sitting in a bank account, and they have debt. Do you realize that at that point, the most expensive money you have is the money sitting in the bank account, because you're not making even enough interest on that money to keep up with inflation. So every month, your money is worth less until it becomes worthless. And you don't want that. So figure out what is the best way. Look at all of your funds and what is the best way to look at them. That's liquidity. Here is an example of our opportunity cost calculator. If you want to know the month, day, and year you could be debt free, if you want to be taught these 8 things on a constant basis, because you have coaching with the P.I.L.L method, you have client support with the P.I.L.L method, you have AI with the P.I.L.L method to do all of the math and give you direction, just like financial GPS, when to do all of these things. And you get to learn along the way so you could teach it to whoever you like. You could teach it to your children or to your grandchildren or to your nieces and nephews. You can teach this information to others, because the information that they're getting out there is all wrong. If you want to get a savings and earnings report, go to ice10k.com. ice10k.com. All right. And click on the link above my head here. All right. You can click on that link. Go to ice10k.com. Scroll down below E.T., the hip hop preacher here. Scroll down below E.T. and click on Get a Savings and Earnings Report. Okay. There you go. And it's we have 2 steps there. Fill out the first step and then fill out your financial data. One of my assistants will get back with you and work with you on how you can, once we verify the data, we'll send you a free savings report, so you'll know the month, day, and year you could be debt free. Okay, month, day, and year you could be debt free. The next thing you want to know is, just like somebody just did, become an affiliate. Okay, become an affiliate right here. Click on that, become an affiliate, and you can make between $300 and $3,000 a month with us. We're sending out emails this week to the affiliates. All right. And we're going to talk about the training that we're going to be doing for affiliates. It's free to sign up to make $300 to $3,000 a month as an affiliate. Okay. We're going to go into more detail there. Once you fill this out, you're not going to get anything when you fill it out. We're going to send you, because we have your email address, we're going to send you out notices for the training. Okay. So that's how that works. All right. So the next thing, get my book, go to Amazon, go to the same card, ice10k.com, and go down to the bottom and click on Get My Book. All right. And then we go down here. Let me see how well the book is doing this week on Amazon. Okay. And let me see here. We were, okay. I'm still in the top 50. I'm at number 38. Number 38. Okay, folks. Out of 33 million titles, that's not bad. Okay. Amazon bestsellers. Okay. The P.I.L.L method is number 38. Okay. That's what's going on there today. All right. So let's go back. So get the book. All right. And become an affiliate, get my book, and become and get your savings and earnings report for free. And tomorrow I'm actually going to be online with an online church. It is Living Manna Online Church. And let me put that on the screen for you. All right. And there we are. So you can see that. It's called Money Answers All Things. And we're doing 8 sessions. And tomorrow will be the 5th session. All right. So tomorrow will be the 5th one that we've done with them. And it's about bridging faith and finance through stewardship. So look up Living Manna. They have a YouTube channel and they have a Facebook page. And then you can watch me live over there tomorrow night. And tomorrow night, we're going to be talking about student loans. So if you know somebody with student loans, get this information, show up there, and we're going to show you how to work those student loans. All right, folks, that's going to be it for today. We're going to be putting up some replays because we're going to be on a little hiatus for a while. And so we're on live Wednesdays, Fridays, and Sundays. And so for the next little bit, you're going to be getting replays on YouTube, Facebook, Twitter, and LinkedIn. We will not be live this Friday. But we will have replays. So there will be information out there for you still 3 times a week. Thank you, everybody, for being here today. And we're going to get out of here. The last person we're going to hear from is Dr. Eric Thomas, and let him tell us about how he made his wife feel so much better after he eliminated his mortgage. Here we go.
Listen to me, y'all. But one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down for my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.